Hello, my name is Belinda Mucklow, and I am on the faculty at the University of Wisconsin. I'm also a CFA charter holder. So what we're going to do in this study session is we are going to discuss financial ratios. Now, I should point out that you should not view financial ratios in isolation as just belonging to one study session, because financial ratios are pervasive throughout the whole of financial statement analysis. So it behooves you to make sure you know these ratios, because they are going to reappear throughout all the study sessions and at level 2. What I will try and do to you is point out the most common ones and the ones that you should know in your sleep, backwards, forwards, and inside out. And where I can, I will try and give you some tips on how to remember them. So let's start with financial ratios. First of all, what you should realize is that financial ratios in isolation have very little meaning. If I tell you the current ratio for a company is 1, it's going to be very difficult to say whether that is good or bad without more information. What other information would be useful? Well, first of all, you could compare to industry ratios. These are widely quoted and probably the most common form of comparison. So you look at your current ratio and it's 1. You see everybody else has a current ratio of 2, and you say, okay, what's going on here? This is an indication you need to examine the issue further. So industry ratios are the most common. Another thing you could do is take selected companies from within the industry and compare to those. This might be something you want to do if, for example, you feel that some of the companies within the industry are not representative of the industry. For example, there might be huge size issues. If your company is much smaller than the average company in the industry, then you may want to just take some other companies of the same size. Another thing you can do is you compare the ratios of a company to its own ratios in prior years. This is extremely useful and can be very revealing. For example, you might look at the gross margin one year and compare it to prior years. If you see that the gross margin is going down, you might question why it's going down, and then you might find out they've been having a lot of sales, something like this. So this is a very common comparison too. Then just in general, you should examine the economy, because the economy is going to explain a lot of variations in ratios over time. For example, if we have a recession, we know that for many companies that's going to mean a decrease in sales growth. If they have a lot of operating leverage, this will also mean that they would have a decrease in their operating margins. So you can't ignore the economy when you're examining ratios. So now let's look at some specific ratios. The first thing we're going to look at are common size statements. So with common size statements, what we do is we express account levels as a percentage of one account. So for the income statement, what we would typically do is express everything as a percentage of sales. So to give you a simple example, imagine we have the year 2002, 2003, and we have sales. I'm just going to do a partial balance sheet here, partial income statement rather. So 200, 300, then 150, 240. All right, so what we would do here, we have sales of 200. Now we're going to express everything for the year 2002 as a percentage of sales. So what this would be, for 2002, if I was preparing a common size statement, this would be 100%. 150 as a percentage of 200 is 75%, and then similarly 50 of 200 is 25%. And then we can do the same thing for the year 2003. Now we're going to express everything as a percentage of sales for the year 2003. So we're always going to have 100% for sales. Then this is 80%, and this is 20%. And we would go right down to net income and do everything as a percentage of sales for that year. Now, as you can see here, what becomes quite apparent here is we've had a decrease in gross margin as a percentage of sales. This shows up really clearly with a common size statement, but shows up less clearly when we're looking at the absolute values of these figures. All right, so as we can see then that looking at common size statements is very useful in examining trends. Also, you could imagine this could be company A and this could be company B, both for the same year. And we could compare them using common size statements, and it's much easier to see that B has a lower gross margin by looking at his common size statement than looking at the absolute numbers. So, comparing different size companies. Now, this is the income statement. We could do the same thing for the balance sheet. There, we would typically make it a percentage of total assets. So we would just rewrite the balance sheet where everything is expressed as a percentage of total assets. Now what we're going to be able to do is we're going to be able to clearly see things like the amount of leverage, or it'll give us clear information on the capital structure, which is another way of saying the same thing. Okay, we're now going to turn to liquidity ratios. In the textbook, they actually refer to them as internal liquidity ratios. This, I presume, is to differentiate them from market liquidity ratios, which we'll talk about later. Market liquidity ratios refer to how liquid is the stock that trades on the company. These internal liquidity ratios refer to, how much the ability of the company to meet its current obligations. So this is as separate from meeting long-term obligations or having long-term good cash flows, which would be solvency. So this is short-term. Now, there are three ratios. The first one here is the current ratio. You have to know this in your sleep. It's really very easy. Let's abbreviate it current assets over current liabilities. It's called the current ratio. It should be pretty easy to remember this. Now, the idea here, obviously, is that current liabilities are your current obligations. Current assets are hopefully what would be used to meet these current liabilities, because current assets are those, by definition, which you expect to convert into cash within 1 year or the operating cycle, whichever is longer. So current assets over current liabilities. Then we move down to the quick ratio. Now, what this does is it excludes some things from the numerator. The denominator, as you can see, is the same. It's still current liabilities. But most notably, that what is happening here is that we have no inventory included. In the numerator, the idea here is that inventory may not actually be that liquid. For example, imagine a jewelry store. It may take them a long time to move their inventory if they wanted to sell it at its regular prices. Also, there will be no prepaid expenses in here, assuming there were some up here, but the key thing is there's no inventory. Then we move down to the cash ratio, which is even more conservative. This would be considered the most conservative. And the numerator simply includes cash and marketable securities. So they have to be marketable securities to be considered liquid. So this is by far the most common that you will see is the current ratio. Obviously, the current ratio must be greater than or equal to the quick ratio, which again is greater than or equal to the cash ratio. So now we're going to move on to some other liquidity ratios. And those liquidity ratios are accounts receivable turnover and accounts receivable collection period. Now, accounts receivable turnover is sales divided by average accounts receivable. Notice it's an average in the denominator. Then, so for example, imagine that a company had an AR turnover equal to 12. That means that it is collecting its receivables approximately, it's taking them about a month. But we can actually convert this into days by taking 365 and dividing by the accounts receivable turnover.